Sustainable investing is ground up. You are looking at what are the companies that are leading us into a cleaner, more resource efficient, more resilient, and more equitable economy. So, in other words, we're trying to look forward. Where is the economy going?
Welcome to the Freedom Point Podcast, where we talk about time freedom, passive investing through real estate, finance, and mindset. Let's dive in. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer. All right, welcome back, Freedom Point Podcast listeners. Thank you again for jumping into yet another episode of the Freedom Point. I'm so glad you're here with us again today. I've got another amazing guest, as I always do. I have Peter Krull. Peter, welcome to the show.
Thank you, Jeremy. I'm excited to be here.
Yeah, likewise, excited to have you as well. So Peter's a partner and the director of Sustainable Investing and Earth Equity Advisors. He's also the author of The Sustainable Investor, as well as the host of his own podcast called Dollars and Change. So Peter, I will be honest with you. Most of our investors, including myself, don't know a whole lot about this kind of topic or concept of sustainable investing. So would love for you to tell us a little bit more about, yourself, your background, your journey, and what you're focused on today in the area of sustainable investing.
Yeah, absolutely. So, yeah, I'll start out with my background. So, my background isn't in business. My background isn't in accounting or anything like that. I actually have a degree in communication. So I started out back in the day working at a TV station and realized very quickly that $12,000 a year was not going to go very far. And so I grew up in Buffalo, New York, and left the area that I was working at the TV station, went back up to Buffalo, worked retail for several years, and really enjoyed that. That's where I sort of that's where I got my sales chops, if you will, and went through this company and just moved up to different management positions, moved up to a director of corporate training. I was training people on how to sell, how to interact with people. And as in much retail, the margins are about yay thin. And so that company didn't make it. And having worked in there for a long time, I got the whisper in my ear that said, bankruptcy is coming. Start taking care of yourself. And one of the people who I had spent time with was a Merrill Lynch financial advisor. I had sold him an Apple computer, and we just became friends. And he became my financial advisor. So I gave him a call and said, "Hey, I'm living in Roanoke, Virginia. Can you get me an interview at the local office?" And he did, and that was in 1998. And so I've been in financial services now for 27 years. And so that's sort of my genesis story in financial services in general. To take that a step farther, to go into the sustainable side or the socially responsible side, I uh, was at Merrill. I started dating my wife, who is right over my shoulder here. Um, she is a double PhD microbiologist and molecular geneticist, so she's definitely much, much smarter than I am. But we were talking about sustainability and climate change and the environment and a bunch of different things related to that. And about the same time, I had a chance to spend an afternoon with a gentleman named Bill McDonough. And Bill at the time was considered one of the preeminent green architects in the world. I mean, he was designing, entire cities in China at the time. And he wrote a book called Cradle to Cradle, which is about something called circular economies. And circular economy is really just sort of an economy that eliminates the concept of waste. When you've got, say, an iPhone or something like that, it's the idea that when you're done with it, it doesn't go back, don't go into the landfill. It gets deconstructed into its constituents and then reused. And so I took the conversations with Melissa. I took the conversation with Bill, and said, I think this is something I really want to do. I grew up outdoors. That's always been an ethic of mine, and jumped off the cliff and left the sort of safe, if you will, financial services spot I had, and started my own firm. And that was 21 years ago, and I've never looked back.
That's great. I appreciate you unpacking your background there and your story. I again, as I kind of mentioned before, I don't know a lot about sustainable and responsible investing. It's not, something that I've naturally been drawn to, mostly because I just don't know maybe enough about it, right? And so maybe you can kind of help us talk a little bit more about, how you talk specifically about redefining, sustainable and responsible investing, and what does that redefinition, look like, and why is that important for investors to know in today's market?
So there's a lot to unpack here as well. So I'm gonna take a step back here, and so the very basics of SRI used to be called socially responsible investing, and it goes back a long, long ways. It goes back to a time when, say, religious folks didn't want to own alcohol, or they didn't want to own companies affiliated with gambling or tobacco, or sort of the sin stocks, if you will. Fast forward to the 70s and the green movement comes along and people don't want to own polluters. And so, a lot of it was at that time was about divestment or not owning companies that weren't in alignment with who you are, what your values were. One of the big changes happened in terms of the strategy was during the South African apartheid regime when uh, investors didn't want to own companies that were supporting that regime in South Africa. And so that's really where shareholder advocacy really started to play into the idea of socially responsible investing. And fast forward a little bit more, we started into what we would call the three legs of it, which is the inclusion and exclusion, including companies you want, and excluding companies you didn't want, or sectors or industries, however you want to put it. That shareholder advocacy component, basically using your proxy vote to push companies to be better. And then the third is community investing, just making sure that you've got money that's contributing back to either your local community or your, however, regional community, however you want to define that. And so that's what socially responsible investing was for a long time. In the early 2000s, this ESG thing came along, and it came from the United Nations. And it was the idea that if investment managers start to look at companies and what their environmental, social, and governance risks are, we might be able to do a better level of due diligence. So, for example, let's say you're a manufacturer and you have a manufacturing facility on the coast of Florida. Well, as we know, the coast of Florida has a tendency to get hit with hurricanes. So the question is there an environmental risk on that company because of hurricanes that come in there? Absolutely, there is. And is it material? Yes, absolutely, it's material. There has been a lot of disinformation over the past, I'm going to say 6, 7, 8 years about what ESG is. And a lot of that comes from legacy industries that don't like the idea that the risks that they're creating, be it fossil fuel companies, mining, et cetera. Um, and so they've teamed up with politicians that are in alignment with them and have really tried to spread the word that this is a bad thing. This is woke investing. But at the end of the day, it really is just about enhanced due diligence. The way they try to frame this is that ESG is about the impact that a company has on the world around it, when the reality is it's just the opposite. It is the material impact on the company itself. And so how do you try and quantify that? So that's ESG. And what we do is we take it one step further than that, because ESG is typically used by, say, the BlackRocks of the world. And what they'll do is they'll take an index, they will layer on some of those ESG risk metrics, and they will make adjustments to the allocation. Maybe reduce ExxonMobil by 0.5%, or maybe increase First Solar by a little bit. But the reality is it's just a less bad version of the original index. That's how I like to describe it. Going a step further to sustainable investing, which is what we do and which is what I talk about often, is sustainable investing is ground up. So it is, instead of starting top down, starting with an index, you're starting from number one here. And you are looking at what are the companies that are leading us into a cleaner, more resource efficient, more resilient, and more equitable economy. So, in other words, we're trying to look forward. Where is the economy going? And you asked me about how we talk about the redefinition of SRI, and that's a great question because again, SRI started as socially responsible investing, and I live in Asheville, North Carolina. We went through a hurricane almost exactly a year ago as we're recording this right now, and one of the things that I recognized is that we now live in a changed climate world. All right. It's not something that's happening in the future. It's actually happening now between Hurricane Helene, Pacific Palisades, the fires, all these things are indicators and have been exacerbated by climate change. And one of the things I realized is that we're not ready for these events to happen. So here in Asheville, we had a failure of our utility infrastructure, we had a failure of our transportation infrastructure, and we had a failure of our communication infrastructure. We didn't have water for 2 months. The interstate between Asheville and Knoxville was out for, I think, 6 months, give or take. Um, and we didn't have electric for a long time. We couldn't pick up the phone. We couldn't use our cell phones. We couldn't get internet. None of that was ready for it. And so that's an important part of sustainable investing. It's not just the sustainability side. It's not just reducing our impact, but it's also recognizing that we live in this climate change world and we need to be more resilient. So the S is sustainable, but the R needs to be resilient. So we need to take a look at what our infrastructure is. We need to look at infrastructure and the failures not just as a risk, but also an opportunity. And I think when I look at where potential opportunities are over the next decade or two, I think infrastructure, especially related to climate risks, is going to be one of our biggest opportunities. And then the I in SRI is about innovation. And innovation is something that can help us become more sustainable, less impactful. It can also help us from the perspective of, how do we deal with sea level rise? And, what are the kinds of innovations we can do to protect cities like Miami or New York? What are the kind of innovations that we can come up with to protect, fire-prone areas, et cetera? And so that's sort of an overview of the different forms of sustainable investing, ESG, everything else, and how I think we're really working to redefine it.
Yeah, no, I appreciate that background, that backstory, and definitely, shows that you have a lot of knowledge, and a passion, for this type of investing. But most of our investors that listen to this, right, they're looking to get investment, tips, tricks, and pieces of wisdom. So how is it that investors, can get involved in investing in sustainable investing? Is there any particular sectors or industries that you see as the biggest growth opportunities for people to get involved?
Absolutely. So we manage portfolios in two ways. We have an individual stock portfolio that we manage that we've been managing for 13 years now. And then we have sort of risk-based mutual fund slash ETF asset allocation portfolios. And I'll talk about those portfolios. So when I'm putting those together, we're using the basics as a core, large, mid, small, international, emerging markets. That's our core. But I think thematics are the important part, and I think this will answer the question that you asked there. And so I focus on 5 different thematics that complement the core. One is energy transition. So how are we transitioning off of fossil fuels? And that could be anything from solar, wind, geothermal, batteries, EVs, and all the components that go into them, and transmission lines, different things like that. Energy transition, biotechnology. A lot of people don't necessarily think of biotechnology and sustainability, but the reality is a healthier society is going to be a more sustainable society. And so, biotechnology has not been one of the best sectors to be in for the last couple of years here, for a number of reasons, everything from interest rates, et cetera. But going forward and looking forward, there are so many exciting technologies, everything from CRISPR-Cas9, which is gene editing, to mRNA, as in, like the COVID vaccines, et cetera, to the use of AI in trying to help speed up new drug and new biotechnology discovery. Some of the numbers I've seen from the AI side of this is that doing a lot of your testing in silico prior to actually putting it into a human could potentially have the amount of time from inception to actual commercialization, and also have the amount of money it takes. 'Cause it takes about $1 billion to bring any drug to the market nowadays. So that's number two. Number three is infrastructure. And again, I already spoke to the infrastructure opportunities from communications to transportation to energy infrastructure. But when I say energy infrastructure, I mean clean energy infrastructure, not necessarily fossil fuels. Um, and let's see, that's three right there. Number four is real estate. So about a third of our emissions come from the built environment, and so that what a lot of these real estate or REITs have basically come to discover is investing in making your buildings more efficient, more water efficient, healthier, actually ends up being better for the bottom line. I know there was a study. It was either by CBRE or uh, I can't think of the other one.
Marcus and Millichap, maybe.
Yeah, no, it starts with a J. No, it's driving me nuts. Anyway, that what they found was that LEED certified buildings rented at a higher rate than non-LEED certified buildings, and so that's the opportunity there. And the fifth one is water. We already are in a water crisis in certain parts of the country, especially the desert Southwest, parts of California, and so water is really the fifth theme that we put into all of our portfolios. So I think those are probably the greatest opportunities. And who knows, next year there might be something else that we add to it, but that's an ever evolving list.
I'm Zach Haptonstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investor. If you'd like to learn about how you can partner with us on these exciting opportunities, and go to our website and set up a call with our team.
I do want to address, maybe this is kind of an elephant in the room question, but it may also be a question that you get more often than not. And that is, really, what's the best way for an investor to evaluate whether an investment is truly sustainable or just quote unquote greenwashing?
That's a great question. And I'm going to look at this from, say, the mutual fund side versus the individual stock side. Because from the individual stock side, it's fairly easy to pick, a company that is actually contributing to a sustainable economy because you look at what are their products, what are their services, is there any ethic associated with it? But when you're looking at mutual funds and ETFs, there's something on the order of 500 different ones that are either low carbon or ESG or green or whatever, there's no limitation in terms of how they're named. And so the bottom line is actually looking under the hood. What are the individual holdings within the fund? And I spend a lot of time on this because the majority of our assets are in funds and ETFs. And so excuse me, taking the time to even if you're just getting on Morningstar or one of the basic services or you can do it for free, just simply go to the mutual fund website and look at their annual and semi-annual reporting, and they'll list everything that's actually held in each one of the funds. Um, but if you see a fund that talks that's ESG or low carbon, and you see one of the major fossil fuel companies in there, I'm going to say you probably want to move on to the next one. A lot of times we'll see something like McDonald's in there, and one of the biggest one of the biggest ESG funds out there from BlackRock. I pick on them all the time about this. They've got Exxon, they've got Chevron, they have McDonald's, they have the parent company to FanDuel, the gambling company. I'm just like, okay, what idea of being a responsible fund um, is I don't understand what your definition of it is. And I talk to financial advisors a lot. That's the book that I wrote, Sustainable Investor, is generally for financial advisors, but it's written for everybody else who's interested in it. But one of the things I tell financial advisors is if you have a client who calls you up and says, "I want to invest sustainably," and you buy them a fund that, like the one I just described, and they have a chance to actually look under the hood, when they get their annual or semi-annual report, they're going to pick up the phone and they're going to call you and say, I asked you to buy me a sustainable fund. Why did you buy me one that has Exxon and Chevron and McDonald's and these things in there? And so I mean, it's important to look under the hood. There's there there's a lot of that, like I said, that ESG less bad kind of investing out there, because ultimately that's what most institutions are looking for, but it's not what retail clients are looking for.
Yeah, no, that makes sense. And it's always a good idea to look under the hood to see what's actually, in the investment. And I definitely challenge investors all the time that you should really only be investing in things that you actually understand, which of course, looking under the hood is a big, part of that. So how do you personally respond, to critics who argue that sustainable investing, is just investing or just injecting politics into investing?
Well, it's not about politics. Politics has been injected into it. So basically, it's the other way around. Politics has been injected into it, and I'll tell you exactly why. So, a coal company in West Virginia didn't like the fact that they were being ostracized, if you will, for their product being one of the main causes of climate change. And so they got in touch with their particular legislators and said, "We don't like this." And then sort of it snowballed from there. And that was the start of the anti-ESG movement. It wasn't anything about there was no true basis for it other than the fact that they didn't want their stock divested from, and it's all documented. Actually, it's in the book. I've pulled all sources from that. Um, the reality is what we're trying to do with sustainable investing is invest in where the economy is going, and which at the end of the day, isn't that the definition of growth investing? I mean, we're just trying to look at it from a from a the fact that we're dealing with an existential crisis in climate change. That's what it is. That is our biggest challenge for humanity at this point. It brings with it risks, but it also brings with it tremendous opportunity. And what gets in the way of this is the legacy economy, the companies that have been around for decades that both refuse to and have not actively evolved for a new economy. I mean, how many of us, I don't know how old you are, but I grew up with a telephone where you actually had to, spin the little dial thing on there. Who uses those anymore? We've all basically have compared to that, a supercomputer in our pocket. The reality is in order for us to generate electric, we're basically doing the same thing as using that kind of a phone back in the day. We haven't moved forward, and the reason is because there's still coal in the ground, and there's still oil in the ground, and there's still gas in the ground, and until we have pumped up every drop, every molecule of gas or whatever it is, those companies are still going to hold on to those legacy energy assets, when the reality is it's ultimately what's going to kill all of us.
Yeah, no, that makes sense. I appreciate that. Most of our investors listening to the podcast, they're primarily, real estate investors, either active or passive. Most of the time investors are partnering, with us on multifamily investment opportunities. So when it comes to sustainable investing specifically, also, given the lens that we're, depending on who you ask, about $4 to $5 million doors light right now, on the single family production side, you could make the same argument in multifamily in certain parts of the, country, especially with the whole affordability, crisis going on right now, and this drift or this navigation towards, renting versus owning. Where does sustainability play in that? Is there any specific, real estate investment type opportunities that you personally, like?
I can't comment on some individual, like, private kind of investments like that. That's really not where my expertise is. I do think that real estate, if I'll give you a personal example. So when we sold our firm 2 years ago, and I ended up buying a private real estate portfolio that was gosh, what are they called? Oh, I can't think of the name, but anyway, doesn't that doesn't matter as much. Um, I had 2 that I was looking at, and one of them, I looked at where their holdings were, and I saw that they were in places like Phoenix, They were in places like Miami, and I can't think of what the other one is, but they were in places that were going to be climate impacted. The second one I looked at was they had apartments in Charlotte, they had apartments in DC, they had apartments in, I think, LA and Denver. And so I think that that's a lens that real estate investors need to start taking a look at. That's lens number one, is what is the potential climate impact for the area that we're investing in? But number two, what is the potential insurance impact? If we're not now, we will very soon be in an insurance crisis because of climate. Um, and we're going to be seeing the areas that are high risk, which usually they're beautiful areas, right? They're coastlines, or that's Northern California, they're places like that. The only people who are going to be able to live there are going to be the people who are able to self-insure, because the insurers aren't going to be able to back them up because the risks are just too high. And so those are the two lenses that, for real estate investors, I would be taking a close look at. What is the potential climate impact, and what is the potential insurance impact?
Yeah, no, that makes total sense, and we're definitely seeing that in some markets, specifically, in the state of Florida, as well as other markets that we operate, in as an owner operator. So appreciate your perspective there. Peter, would there be anything else that you'd like to kind of leave our listening audience with? Any other words of wisdom related to kind of the sustainable energy investing arena?
So, the reality is that the next generation of investors is really interested in sustainable investing. So, according to Morgan Stanley, 99% of Gen Z, 97% of millennials, and 86% of Gen X are either somewhat or very interested in sustainable investing. And so, a lot of the folks who might be poo-pooing it or might be saying, "No, this isn't something real," don't understand the fact that these next generations, this is something that is going to be very important to them. They care about what their impact is. They care about the fact that we're not really doing anything for climate change, and they're going to look at us somewhere down the road and say, "The hell is wrong with you? Why didn't you do something?" And so they want to be doing something with their money. And, from my perspective as a financial advisor, you know, any advisor that is at least getting to understand, and you don't necessarily have to be an expert like I am on it, but you have to at least be able to understand it and help that next gen. Because when grandma, grandpa, mom and dad die and that money gets passed down, I mean, first of all, statistically, 70% of those assets aren't going to stay with the advisor. That's just it, because they typically don't have a relationship. But you're even less likely to keep those assets if you don't have the kind of investments that they're really interested in. So, I think that this is a next gen thing. So, I'm not necessarily expecting that the baby boomer is going to walk through my door to do this, even though we have a lot of baby boomers as clients. Um, what I'm anticipating is it's next gen. It's my generation, Gen X, millennials, and Gen Z. So, and then the final thing I'll say is check out my book. It comes out on November 3rd. What's it? It's sustainableinvestorbook.com to pre-order.
That's great. Well, that's about the time that this episode is going to drop. So appreciate that. And also appreciate, your perspective on this topic, which doesn't get talked about, all that often, in the circles that I run in, but certainly is exciting to know that, you feel and others feel that we're on, kind of the very beginning stages of this, investing momentum, that exists, in the sustainable, energy space. And, with that said, Peter, would there be, one or two different ways that our listening audience, outside of checking out your book, is there one or two ways that we can connect with you offline to learn more?
Yeah, absolutely. Our main website is just earthequity.com. And I also have the Dollars and Change website that you mentioned earlier. So check that out as well.
That's great. Well, we'll definitely put those links in the show notes for the episode. Peter, thank you for the tremendous value that you've brought our listening audience today.
Thanks, Jeremy. It's been fun.
Absolutely. And listening audience, thank you again for jumping into yet another episode of The Freedom Point. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point Podcast. Written permissions must be granted before syndication or rebroadcasting.